Dear investor, the month of March saw a rebound from the correction seen in January and February. Equity markets rebounded, as did currency markets. First half of April again saw a correction as the impact of the duties levied by the US on the world was significantly higher than what was expected. While impact on India was relatively lower and we were seen as benefiting overall, markets were weak and gave away a lot of the gains made in March. However, once tariffs were deferred by 90 days, ex of the base 10%, and remain and frankly expanded on China and some other countries, markets regained strength and rebounded. Large cap indices recovered their losses for the year, supported by the financial sector, which was helped by better systemic liquidity and regulatory interest rate cuts. News flow in the market from global happening expected to continue, and hence a higher degree of volatility in the next period should be expected. However, on the positive side, the net effect of the events till date is not negative for the Indian economy. It may be net positive. What we may have lost to potentially slower global growth on account of higher tariffs, we have more than gained on lower oil prices. Additionally, it is now clear that the US wants to claw back manufacturing back from China and is taking steps to do so. This process could present meaningful opportunities for Indian manufacturers, especially in low value added and labor intensive spaces, which we believe the US would not want to enter into. It will focus more on the higher tech spaces. It is also clear that the two largest economies are well entangled, and disentanglement could take years to process. And in the interim, a period of reconciliation and normalcy could be expected to give industry time to untangle and create new supply chains. So, we can expect a period of reconciliation. That is something we should be ready for. On the economy front, CPI inflation remained under control at 3.3% in March versus 3.6% in Feb. So that's a good indication. Two, goods trade deficit widened a bit to $22 billion from 14 billion in Feb. But yet, maybe on current account, we should look balanced. Foreign portfolio investors turned buyers on a few days in April versus being consistent sellers, and that aided to the positive sentiment. Forex reserves have improved for 5 weeks on the trot, and INR has again appreciated in the period, let's say, from 10th of April onwards. Result season has started. In this season, aggregates are expected to remain weak as large spaces like banks, tech services, metals, oil and refining, and autos deliver low earnings growth. Other spaces, including capital goods, electronic manufacturing, renewables, luxury, chemicals, new tech, defense, and select pharma, are expected to deliver stronger profit growth. In the next fiscal, while the smaller growth spaces are expected to continue to deliver strong numbers, larger sectors like oil, refining, metals, and banks could deliver better growth as the low base of this year helps. We are focused on smaller niches where growth is expected to sustain stronger over the medium term. Amongst the smaller sector, we believe that capital market players may also see strong growth in addition to the spaces outlined above. Interestingly, while the initial few results from IT companies have been below expectation, the market reaction has been measured. Similarly, one of the capital market companies saw poor results, but again the market reaction was measured. In the past few months, such results would have resulted in a significantly larger impact. To us, it suggests that following the recent market corrections, valuations are way more sustainable than before. If the markets has stopped reacting to negative news, it points to positivity going forward. Policy direction is clearly moving in the direction of making more in the country, not only in India, but around the world. Deglobalization appears to be gaining strength. In India, Make in India is getting a fillip. Recently, discussion paper was floated to increase the domestic content in, let's say, windmills, and a PLI on semiconductor was brought out. Steps taken by the US against China and its satellite countries could potentially provide market access to Indian players. With global trade conflicts, it seems world is warming up to the potential of Indian market, and newspapers have been reporting softening of trade stance by both the EU and China towards India. This may prove supportive for low-cost manufacturing in India. For example, according to reports, Foxconn is exploring a large facility in UP, and this could just be the sign of times going forward. Valuations are supportive, with many growth-oriented spaces having corrected over the past period. We listed out such segments earlier. We are a growth-focused investor and believe that over the long term, earnings growth has the potential to contribute positively to investor outcomes. Our portfolios aim to maintain reasonable representation in sectors with high growth potential. This growth-oriented approach naturally results in lower exposure to sectors with relatively muted growth prospects. Once again, we shared some spaces earlier. In this period of high volatility, it helps that most of the high growth spaces identified by us are focused on the domestic market. Happily, over time, some of them could benefit from the opportunities that the US market may open up, but that is over a period of time. Also, most of the businesses, except financials, are net cash on book, which again helps in period like this when equity fund raise may prove to be more difficult. As the result trends have been showing for a few quarters now and are expected to continue, some established businesses, including several in the indices, have seen moderated earnings growth. So a lot of the index spaces is seeing growth moderation. Compared to the past trends, let's say 2008 to 2020, whatever these guys delivered, now we are seeing relative slowdown there. At the same time, newer businesses have been contributing more to overall growth. Our portfolios have a high representation of newer businesses with a belief that over time, relatively higher growth, valuation adjusted, may translate into better outcomes for our investors. While this result season is expected to be low growth on aggregates, in the new fiscal, the low growth of this year could prove to be a good base, and we expect earnings growth to be reflective of nominal economic growth, maybe a tad higher. This should go a long way towards improving sentiment. India has been a neutral country in this era of trade wars. For global money, there are lesser investment avenues. China and US may want to disentangle their financial markets also from each other. EU always has an eye on potential risk and is a very process-driven geography. The same may drive it to also disentangle itself from both US and China. India has the potential to be the next largest real market and capital market, and may find increasing acceptance as an investment destination. We believe we have a lot to look forward to. Now, import duties have been only paused by the US for 90 days, post which we may expect another round of volatility. However, there remains a possibility that India and the US may arrive at a favorable trade understanding during this period. Many of the indicators, such as DXY, which is below 100 for the first time in a year, weakening USD, with INR and other currencies, with INR strengthening to actually Jan levels, low crude prices of around $65-66 per barrel are all supportive of emerging market growth asset class like equity. Now, while US bond yields have spiked, they are again close to 4.4. It is probably mostly on unwinding of basis trade, and it remains lower than the 4.8 recent peak. While uncertainty remains high and risk appetite low, we think a gradual normalization of these factors may contribute to improved market conditions. With investors disengaging from the largest global markets, India could benefit strongly even if a small percentage of the money comes to us. We do expect to see going forward many more EM funds, ex of China, getting launched, which would mean those funds will have India at the core. So on that positive note, thank you. Happy investing and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.